When people think of ETFs, their first reaction is often index funds, like the well-known S&P 500. But in reality, index ETFs are just the tip of the iceberg. The ETF universe is far richer than you might expect. It's not just an investment tool. It's a complete system that spans nearly every major asset class across global markets. In the US, which is the world's largest ETF market, there are now over 4,000 ETFs listed, covering virtually every type of asset and investment strategy you can imagine. So if you're just getting into ETFs, instead of immediately asking which one should I buy, it's more important to first understand a more fundamental question. What exactly can ETFs invest in, and how do the different types relate to or differ from one another? In today's video, we'll explore the world of ETFs by asset class and help you build a solid foundation for long-term portfolio. Let's start with the most common and arguably most essential type, equity ETFs. These are designed to give you exposure to the stock market. When you invest in an equity ETF, you're basically buying a basket of company shares all at once. For example, buying SPY means you're investing across 500 of the largest companies in the US. Then there are sector-specific ETFs like XLK, which focuses on the tech industry and includes names like Apple, Microsoft, and NVIDIA. You'll also find factor-based ETFs that target specific characteristics like growth, high dividends, or low volatility. But regardless of the theme, these are all stock-based products, meaning they share similar risk profiles. The advantage of equity ETFs is strong long-term growth potential. They're often the main driver of returns in a portfolio, but that comes with higher volatility. For example, XLK saw a drawdown of up to 80% during the dot-com crash. So if you're investing in equity ETFs, it's important to understand the systemic risks of the stock market. Because of this volatility, it's important to pair equities with assets that have different risk characteristics. That's where bond ETFs come in. These are one of the most critical tools for diversification. As the name suggests, bond ETFs invest in various types of bonds, government bonds, corporate bonds, high-yield bonds, and so on. For instance, BND is a large ETF that covers the entire U.S. bond market. Investing in BND is like lending money to the U.S. government and companies in exchange for interest payments. For those seeking steady cash flow, bond ETFs are an essential asset class. They tend to be less volatile than stocks and often serve as a hedge in times of economic slowdown or rising risk aversion. When panic hits the market and stocks fall, bond prices often rise. That negative correlation helps cushion your portfolio. Bonds won't deliver explosive returns, but they play the role of a stabilizer, providing a buffer when markets get rough. Another category worth watching is commodity ETFs. These invest in physical assets like gold, silver, oil, and agricultural products. Their prices are influenced by supply and demand, geopolitical tensions, and inflation expectations. Gold ETFs like GLD are commonly used as a safe haven. When inflation runs high or global risks escalate, commodities often move differently from stocks and bonds. That means they typically have low or even negative correlation with traditional assets. Adding some commodities to your portfolio can improve diversification. That said, commodity ETFs can be quite volatile themselves, so they're not ideal as a core holding. But in times of crisis or extreme market stress, they can act like insurance, offering valuable protection for your broader portfolio. Next, we have REITs, real estate investment trusts. These ETFs invest in real estate companies, especially those that own income-generating assets like shopping malls, office buildings, or warehouses. REITs are a hybrid of sorts. They trade as stocks, but generate income more like bonds, primarily through regular dividend payouts. V&Q is a popular example of REITs that includes many of the top real estate players in the U.S. REITs tend to be correlated with stocks because they're publicly listed companies, but they're also very sensitive to interest rates. When rates go up, REIT valuations often get compressed. But during low-rate environments, their high dividends can be especially attractive. So REITs can offer a nice balance of income and growth, making them a good addition to portfolios looking to boost cash flow. Lastly, we have thematic and strategy-based ETFs. Think of these as a flexible toolkit. They can invest in any asset class, but they come with specific strategies or structures. For example, TQQQ, which we discussed in a previous video, is a leveraged ETF. Then you have inverse ETFs like SQQQ that are used to hedge against market downturns. Some strategy ETFs use derivatives like options or futures to boost returns. Take JEPI, for instance, which uses the covered call strategy to generate extra cash flow. There are also multi-asset ETFs like AOR, which holds stocks, bonds, and cash all in one fund, essentially a pre-built portfolio for hands-off investors. Just this past March, Bridgewater launched the ALLW ETF, bringing Ray Dalio's famous all-weather strategy to retail investors. It allows everyday people to access institutional-grade diversification with a low barrier to entry. The risk and return profiles of these strategy ETFs can vary widely. Some are speculative, while others are conservative. What they share in common is complexity. So before you invest, it's important to fully understand how the strategy works and where the risks lie. Don't just jump in because of attractive returns. Hopefully, today's video has given you a clearer, more systematic view of the ETF universe. Different types of ETFs serve different purposes. Some aim for growth, some provide defense, and others focus on generating income. Once you understand how they behave in different market environments, you can begin building a portfolio that matches your goals and risk tolerance. And thanks to the wide availability of low-cost, transparent ETFs, everyday investors now have access to tools once reserved for institutions, making global asset allocation more accessible than ever. If you found this video helpful, be sure to like, subscribe, and hit the bell. I'll see you in the next one.